On March 2016, Copen takes out a loan. In this unit, we're going to analyze and account for that transaction. But before that, let's review the previous unit. It focused on the analysis and posting of labor and general expenses corresponding to 2016. With respect to cash flow, this transaction involves two payments. On the one hand, Copen paid up labor expenses. On the other hand, Copen paid general expenses generated between January and October. General expenses accrued in November and December will be paid up in 2017. The transaction also involves the two above-mentioned expenses that the income statement now reports. At last, the balance sheet should reflect a liability due to the general expenses accrued in November and December. The payment of those general expenses is pending at the end of 2016. Once again, it's necessary to recall that the balance sheet does not show any cash variation yet. This is because we will jointly reflect the impact of cash on all the transactions once we have calculated the net cash flow of the year. The transaction that we're posting hereafter refers to the loan that Copen took out on March 31st, 2016. First of all, as we did in the previous transactions, we identify the possible collections and payments that could have taken place in 2016 due to this loan. In other words, we will determine the possible cash inflows or cash outflows related to this transaction in 2016. When Copen borrows on March 31st, 2016, they collect the principal of the loan, 50,000 euros. And on December 31st, 2016, the company pays for the interest accrued until that date. That's to say, Copen pays for the interest that they incurred the obligation to pay until that point in time. Since the annual interest rate is 5% and Copen borrowed after January the 1st, we should calculate the share of interest generated between March 31st and December 31st. That's to say, 9 months. We therefore record both the collection and the payment on the cash flow table. We show also the intermediate calculations, even though they are obvious, for the collection of the principal. It's a good way to strengthen the operating procedure that we are using to deal with this type of cases. We now search for possible incomes and expenses with regard to the loan. Thus, if the company's value decreases, increases, or in other words, if Copen's wealth increases due to this transaction, we will be able to state that borrowing this loan involves an income. On the other hand, if the company's value decreases, or in other words, if Copen's wealth decreases due to borrowing that loan, we will be able to claim that this transaction involves an expense. As mentioned above, within this context, company means the entire company shareholders unit. The answer is that the loan involves some expenses, in particular the financial expenses related to the interest that Copen incurs the obligation to pay. In fact, a loan can be viewed as the rent of a specific resource, which is cash. By borrowing, Copen acquires the right to use for 1 year a certain amount of cash, the principal of the loan, that actually belongs to the lender. In return, Copen should pay to the bank a rent, which is the interest. However, this transaction does not involve any income. Indeed, the company collects the principal, but they owe it to the bank. Copen's wealth, therefore, has not increased. The accrued interest since March 31st, 2016, when Copen borrows, to the end of the year, when we are carrying out the analysis, have to be recorded on the income statement. The column of intermediate calculations shows how we obtained this record. In this case, interest payments and interest expenses amount the same. This is because the accrued interests are paid up at December 31st, 2016. However, if the payment took place on a single date each year and that date would not be December 31st, the closing date of the year, those amounts would be different. Finally, we analyze how the loan affects two other assets, liabilities, or capital. Ultimately, we need to find out if the loan may cause variations in the belongings, the rights, the liabilities, or the capital of the company. So, yes, a liability changes. The liability reflecting that Copen owes to the bank the principal of the loan at December 31st, 2016. Copen has to repay in full that amount on April 1st, 2017. That's to say, during the following year, and that's why it's a short-term liability. It's clear that this transaction does not involve any modification in capital, since the shareholders neither bring in or nor reduce capital. This debt to the bank is recorded on the balance sheet. In particular, it's recorded on the liabilities section because it represents a payment obligation of Copen. It might be wondered whether Copen should reflect a short-term liability on its balance sheet at December 31st, 2016, corresponding to the interest that will be accrued throughout the first quarter of 2017. This is a very important point. The answer is that future interest should not be reported because these have not been accrued yet. That's to say, Copen have not incurred the payment obligation yet. Loans usually can be early repaid. That's why the payment obligation of the related interest should not be recognized until the interest have not been accrued. However, if the terms of the loan contract stated that the loan can't be early repaid, the payment obligation of the future interest should be recognized as a liability on the balance sheet. Let's summarize this unit. Throughout this unit, we've accounted for the transaction related to the loan that Copen took out on March 31st, 2016. Regarding cash flow, that's to say, collections and payments, in 2016, Copen collected the principal of the loan and paid up the interest generated in 2016. The financial expenses due to this loan interest are now recorded on the income statement. Let's recall that collecting the principal does not involve any income because the company has to repay it in full, which means that the wealth of the Copen has not increased because of that collection. Lastly, the balance sheet shows that Copen has to repay the principal of the loan in the short term. This fact is recorded on the short-term liabilities section. In the next video, we analyze and post another transaction, which describes the purchase of machinery on April 1st, 2016.